How to legally take tax-free income like Hillary Clinton. My name's Daniel. Last year we set up the strategy for 24 clients. Here it is. First, what she owns. According to a 2016 article, she has 5 different permanent cash value life insurance policies. 2 of those are whole life, the cash value ranging in total between those two from 30 to 100,000, and with the universal policies from 1.25 all the way up to 2.5 million, not just in insurance or in death benefit, but in cash value that she can access tax-free. Now that's a lot of life insurance. Why does she own all of those policies? Simply because Ray Kroc, the founder of McDonald's, because J.C. Penney, because Tony Robbins, because the Rockefellers, because big banks. Bank of America has 24 billion in assets in cash value life insurance. Wells Fargo over 19 billion. The entire big banking industry over 205 billion. And if all of them are doing it, maybe that's why she thinks there might be something to this. Now, technically, politicians understand the tax codes. First, we're going to look at 3, 101A, 7702, and 72E. Now, if any of you have ever had a life insurance policy and had a loved one pass away, and you or someone you know was the beneficiary of that money, you would know that according to tax code 101A, this money is transferring income tax-free. So whoever the beneficiary was, they did not have to pay taxes because they received that money. So if someone had an insurance policy to pay off a funeral, to cover living expenses, to help raise the children, they are not paying any income tax on that money. Tax code 101A outlines that. Tax code 7702 says that money inside of a life insurance policy that is cash value, that is growing, is not actually growing tax-free, but is growing tax deferred. Now, you might think this sounds like a 401k. The difference is you are able to access this money, according to tax code 72E, income tax free. You can withdraw everything that you put in, first out. Everything above that's going to be taxed because the money is growing tax deferred. But you can also access this money through what are called policy loans. These, according to the Internal Revenue Code, are completely income tax-free. There's a couple different ways to do this. Essentially, you are loaning the money from the insurance company based on how much cash value you have, and then you are able to get credited interest from the insurance company that is usually equal and opposite to the rate that you're loaning at, so it covers it in some cases. We won't get into them in this video, but you can actually earn more than the amount that you're paying on the loan from the insurance company, making it a positive arbitrage. Now, let's look at a couple more tax codes, because if this is the case, then why would these politicians not put $1 million in for $1 worth of insurance and basically just have $1 go towards the insurance, the other $999,999 go towards the cash value, and just kind of abuse the tax system? Well, that might have been pretty close to the case in 1980 when Universal Life came out. They quickly realized this in the Tax Equity Fiscal Responsibility Act and the Deficit Reduction Act in 1982 and 84, defining the minimum amount of insurance that someone has to have for the rest of the money that's going into the policy to be considered cash value, for it to still be considered life insurance. So if you're not hitting that minimum, you're not going to get all of these tax benefits that we just showed there before. Now, you also can't just lump sum money in. You were able to do this initially, but as of 1988, the Technical and Miscellaneous Revenue Act makes it to where you have to spread out this money. So if Hillary Clinton wanted to put in $1 million into a universal life policy today, she couldn't do that in one go and keep all of these tax benefits, but instead she would have to spread that out over usually about 5 years. Of course, as she's putting money in the policy, then all of those tax benefits are going to apply. Comparing this to a 401k, to an IRA, they think of this as a no-brainer. That's why they have so much cash value life insurance. Now, it's not as simple though as just buying any whole or universal life policy. They have to be structured in a certain manner. So that is, when you put money into a policy, you want the most amount of money as defined by the Internal Revenue Code to go towards the cash value for it to still be considered life insurance. And of course, that means you want the least amount going towards the death benefit. When this is the case, your money is still going to be considered life insurance, so you're still going to get all of these tax benefits, and the least amount pays all of the cost of insurance and fees. The most goes towards the cash value, which is growing tax deferred, and you're going to be able to access that tax-free. As an example, a 6-year-old male who wants to move over $500,000 over the course of, say, 5 years, usually is going to need about $1 million in death benefit. That means after he's funded the policy with that $500,000, he's only actually going to be paying for $500,000 worth of insurance. And then as the cash value continues to grow, so if it grows from $500,000 to $700,000 over time, well, then he's only going to be paying for $300,000 worth of insurance, and the other $700,000 is considered part of that $1 million death benefit. Now, here's how this works with what is called an indexed universal life policy. You have money and you want to put that into a policy. You're going to do that. Part of it's going to go towards the death benefit. The rest is going to go towards the cash value. Now, how does this money grow? Well, that cash value, that money that you put into the policy, is going to get credited interest. So think of a high yield savings at a bank, or even just a regular savings account at a bank. If you put money in there, usually you're going to get credited some sort of interest. With a high yield savings, a bank is usually able to credit you currently about 3.7 to a little above 4% return. Of course, in a bank, that's always going to be taxable. In the insurance company, as cash value, it's not going to be taxable. And the reason that the banks are able to credit you, say 3 or 4%, is because they're actually taking your money, they're going out and investing it, and they are earning more than that. Therefore, if they're going to earn 5%, they can afford to credit you 3 or 4%. Now, let's say you put in $1 million into a policy like this and you are getting credited 4% interest. That means you are getting $40,000 a year, income tax-free. Now, if you just wanted to let that continue to compound, next year you're going to get 4% on the $1,040,000, you can do that. However, if you would like to make those returns a little bit higher, what you could do is take risk, not ever with the initial million that you put in. That's not what we're doing. We want to make sure we're protected. So if this risk that we take goes wrong, for example, if we put money in the market, that we're protected, our million's always going to be there no matter what happens in the market, no matter if there's a terrorist attack in the United States, no matter what. So instead, we are just going to use the interest. So in this case, the $40,000 that you were credited, and we are going to only take risk with the interest. Now, we are going to buy what are called call options. So we're going to go off to the side here and explain how these work and how we're able to participate in the market's performance up to a cap, but never lose when the market goes down, and have that happen for our full million, even though our million's not in the market. Take a look at this. So if you had a home, for example, that was worth $100,000, and I want to buy that home, but I don't want to buy it today. I actually want to buy it a year from today. Things just aren't right now. I'm kind of locked in with a lease at an apartment here, and I want to wait a year until that's over so I don't have to pay any fees and buy it a year from today. Well, what I'm going to do is I'm going to offer you, can I pay you a fee to lock in the price that it is today and then have the option to buy it at the price it is today a year from today? I don't have to exercise that option, but I at least want the choice. You accept. So I pay you a fee which is going to be equal to the amount of interest that I received. So $4,000 or 4% of the cost of the home. Well, a year from today, let's say the home went up in value to $110,000. Well, thankfully, I paid you that fee. I don't have to pay $110,000 for the home. I only have to pay $100,000 for the home. So I do that. Now I own the home. I bought it for $100,000, but the home is worth $110,000, right? So that means if I were to go and sell that home, I could sell it for $110,000. It's now worth $10,000 more than I bought it for, but I never even risked my initial $100,000 to get this gain. So I just made 10% on the $100,000 without ever risking it. Now here's the best part. Let's say the home went down in value to $80,000. Remember, I wasn't guaranteeing myself to buy this home for $100,000 in a year from now. I was just making it to where I had the option to buy it for $100,000. So if the home goes down to $80,000 in value and I still want to move, I don't have to buy it for $100,000. I can buy it for $80,000. In fact, I don't have to buy it at all. So in this case, am I going to buy it for 100,000 when I could buy it for 80? Of course I'm not going to do that. If I had bought the home a year ago, well, I would have just lost 20%. I don't lose a dime because the value of the home goes down. In this case, when the home went down 20%, I didn't gain anything, but I didn't lose anything due to that. And the exact same thing works when you're linking to an index. So like the S&P 500, if it went up 10% in a year, you can exercise that option. You just made a 10% gain, income tax free. If the S&P 500, like the early 2000s, like 2008, went down 40%, I don't lose a dime because of that. My money's safe. I didn't gain anything, but while everyone else who was in the S&P 500 lost 40%, I don't lose any money due to that. And here's the best part. When you make a gain, so when the 100,000 turns into 110,000, for example, we are able to lock in that gain and reset. So that money, that gain that we just made, the additional $10,000, is going to be considered part of our new principal. And that is our new floor, meaning we can not only never lose the 100,000 due to market downturns ever again, but the full 110,000, which includes the gain we made the previous year. Think of it like a ratchet wrench. When you turn that wrench to the right, is the bolt going to get tighter or looser? It's going to get tighter. Now, when you turn the bolt back to the left, does the bolt get looser? When the market goes back to the left, do you lose money? No, you do not. You do not lose anything because you turned it to the left. Look at this example here. If you had $500,000 in cash value, the market gains 10%, you gain that full 10%. So now you have $550,000 in cash value, completely tax-free. Now the next year, the S&P 500 goes down 20%. Do you lose that full $50,000 from last year and more? Well, actually, no, that's not the case because you locked in that $550,000. So what happens? You still have $550,000. Well, the next year, it gains 10%. Now, of course, we're going to participate in that gain. We get the 10% gain. We now have $605,000. The next year, the S&P 500 goes down 5%. A little bit of a bad year. Do you lose 5%? No, you locked in your gain. You still have the $605,000. Next year it gains 10%. You have $665,500 income tax free. Now at this point or at any point when you decide you want to start taking tax-free income, you can start doing that. And since you don't have to worry about the market going down and having to drastically lower your withdrawal rates because of that, you don't have to stick to this industry standard financial advisor rule of only taking 4% a year, but usually between 6 to 8%, sometimes even higher. If you took 7%, that is around $46,500 income tax-free for the rest of your life. Now compare that to a taxable vehicle. If you're in a 33% tax bracket, multiply this number times 1.5 just to get that $46,500 for the rest of your life. If you're only taking 4%, make sure you multiply that by another 1.5. If you have a financial advisor fee, make sure you add another 1% a year onto that number. There's just nothing like this in the Internal Revenue Code. There's also different riders you can add on. Every policy, for example, gets a chronic illness rider. That means if you cannot perform 2 of the 6 activities of daily living, you would then be able to access your death benefit early, kind of like a long-term care insurance. There's some things it doesn't cover, and if you're worried about some of those, there is long-term care riders. There's also terminal illness rider. So if you're deemed to have a terminal illness, only 12 months to live, you could also access that death benefit to help pay for this. If you have a critical illness, same thing, you'd be able to access the death benefit early. Also, since these policies are funded with post-tax dollars, you are completely opting out of any tax rate volatility in the future. So if you have a concern that taxes may rise in the future, most people seem to think taxes are not going to rise in the next 4 years with Trump in office, as historically, when Republicans are in office, taxes tend to go down or stay the same. But when the opposite is the case, taxes do tend to rise, and that's generally how the Democratic Party wants to increase revenue, is by raising taxes, especially on the higher earners. So for someone like Hillary Clinton, who is a Democrat, you can totally understand why she has money inside of cash value life insurance. She's opting out of the tax rate volatility. Also, one of the biggest things about these policies is now you will not lose due to market downturns. Because that's the case, your money is sorted. You're not taking risk. No unnecessary money is in the stock market. You can focus on the things that matter most to you. Your family, your children, your faith. You don't have to worry about having to go back to work because the market takes a big dip. You've optimized for your life your peace, as opposed to taking unnecessary risks in the stock market, trying to hit home runs, and hopefully praying that history never repeats itself again. Even if you have money in deferred accounts like 401ks and IRAs, you can even do what are called strategic rollouts. Plan to get money out slowly over the years with the least amount of taxes possible, get the taxes over and done with, and get it into a completely tax-free vehicle. Grows tax deferred, but you access the money tax-free when you pass away. It transfers tax-free. The death benefit would pay off any loans that you have. So even though it grows tax deferred, you never have to realize that deferral status. It's all tax-free. If you'd like to learn about these in much greater detail, click this video here, and I will see you there.